What is going on, you guys, and welcome back to another video here on the channel. We got a bit of a different style of video, but hopefully it proves to be quite helpful. This is a question that I'm seemingly getting a ton of recently, but today we'll be talking about withholding tax on your US dividends. And if you do have a pretty good understanding of what you're looking at here, feel free to take a screenshot, feel free to pause the video and really break it down. This matrix here does kind of give you an explanation in terms of, are your dividends subject to a 15% withholding tax? In the TFSA, the answer is yes. In the RRSP, the answer is no, with an exception here of a Canadian listed ETF. And then in the non-registered account, the answer is obviously yes. This is our taxable account. Now, for somebody that isn't as advanced, I will go on to explain a little bit deeper how this works and what you're looking at. But again, if you're just coming in here for a simple answer, you want to know, are your dividends subject to withholding tax? This matrix right here basically explains that. Now, for our beginners on the channel, what are we looking at here? Well, as a Canadian, if you go out and buy a foreign investment, okay, if you go buy a US investment and that investment pays you a dividend, well, that dividend may be subject to a withholding tax. In other words, they may withhold 15% of that dividend. And when I say they, I know the question will come up. It's the IRS who withholds 15%. Reading here, the rate charge is actually 30% by default, but it's reduced down to 15% because of a tax treaty between the US and Canada. And we'll talk about this in just a second here. But the point being is that there's two variables that determine whether or not your dividends are going to be subject to withholding tax, and that is obviously the account that it's held in, as well as the structure, as well as the investment type, whether it be a direct security, whether you get your exposure through ETFs, US and Canada listed. And by the way, I forgot to mention, I will include these two really good articles down below the video if you want to do some additional reading. This is one by iShares by BlackRock, and it has a pretty good chart here that you can screenshot or take a look over, as well as an article here by PWL Capital. And this one is actually very in-depth. It'll give you a really good understanding if you want to go through and take a read after. I'll link both of these down below this video for you guys. But essentially, what you need to know at the base of things, what is important to recognize, what is important to interpret from a chart like this. If you buy a US stock, okay, I have here example Coca-Cola, Procter & Gamble, or Walmart. If you buy that stock in your TFSA, it is subject to a 15% withholding tax. The dividends, are subject to a 15% withholding tax, whereas if you bought that exact same stock in your RRSP, they are not subject, they are exempt. And the government does recognize the RRSP as a retirement account, and as a benefit of that, they do exempt the 15% withholding tax. So technically speaking, you would receive less of your dividend on the exact same stock in a TFSA versus an RRSP. Now, non-registered accounts, these are our taxable accounts. So yes, in all cases, they are going to be subject to tax. And I actually do have a bit of an asterisk here, because by default, they're actually going to withhold 30%. So like we kind of touched on here, but what you can do is you can fill out, this is where you may have heard of the W-8 Ben form. This is a form that you can file with your broker, and that will reduce those dividends down to 15%. So a question I know will come up is, and that's why I have this asterisk here, right? Tax credit available, the foreign tax credit. I know someone will be asking, well, can I file the W-8 Ben in my TFSA or RRSP? No, you can't, because these are not taxable accounts. And this is already reduced to the minimum here of 15%. And in the RRSP, you're not even paying any tax, or you're not even getting any of your dividend withheld. This only applies to your non-registered account, where you're getting a tax slip at the end of the year. So yeah, that just clarifies that up. Now, a couple points here on the ETFs. If you are an index investor and you decide to get your US exposure through ETFs, they are taxed slightly differently. Now, what am I even talking about here? Well, a good way to explain the difference between a US listed ETF and a Canadian listed ETF is, you could have two funds that are essentially the same. They both invest in S&P 500 companies, right? They're both a way of getting exposure to the US market, but one of them is traded on a US exchange, in other words, the New York Stock Exchange, in US dollars, such as, for example, VOO, which is an American Vanguard fund. And in Canada here, we have XSP, a Canadian company, iShares. They still invest in US companies, but this is Canadian listed. It trades on the TSX and in Canadian dollars. So that's what I mean here when I say US listed and Canadian listed. If we do want to just get like a little bit better explanation there, here's an example. This is on the American website. This is Vanguard.com, so the US version. Here is the US fund, VOO. So again, it invests in the 500 largest companies in America. This here is the Canadian version of a very similar fund. So it's an S&P 500 fund. If we actually go down to the holdings, what we see is actually this is a Canadian ETF that actually invests in a US ETF. So think of it kind of like it's wrapped up, right? There's a fund there's a US fund within the Canadian fund, but this one is still denominated in Canadian dollars. If we take a look over somewhere here, sorry. Oh, so here, exchange. It trades on the Toronto Stock Exchange and it is denominated in Canadian dollars. So that's what I mean when we talk about the difference here. Now, in your TFSA, it doesn't matter whether you're using a US listed or a Canadian listed. They are both subject to a 15% withholding tax. But in the RRSP, this is where it gets interesting in that a US listed ETF, if you went out and bought, for example, VOO in US dollars on a US exchange, that fund is exempt from the withholding tax. However, a Canadian listed fund is subject to a 15% withholding tax. So this is really just the only discrepancy here that you should be aware about. It's something to factor in. It's something to be aware about. But to just finish up this video and to kind of give you some key takeaways here in terms of what you should be interpreting from a chart like this. My first takeaway, as I will always tell you on this channel, is don't let the tax tail wag the dog. That's something that we love to preach over here. And what that means is that we don't want to make our investment decisions based off of and simply based off of taxes. That is something to factor in, but the primary objective should be focusing on our investments. And then secondary to that, then we worry about withholding tax. Then we worry about the tax situation. I know everybody wants to be as tax efficient as possible, but just keep that in mind. We want to worry about the investment first and then the taxes. But as a rule of thumb, factoring that in, US paying dividend stocks are technically more favorable in a tax perspective in your RRSP. If you factored everything out and you just looked at strictly the tax results, a share of Coca-Cola would be more favorable to hold in your RRSP than in your TFSA because you'd be receiving 15% more of your dividend. ETFs here, as you can see in your TFSA, they're all subject to the 15% withholding tax. So for Canadians, you're most likely going to want to stick with your Canadian listed option. Now you may be thinking, well, in my RRSP, if I want to take the route of index investing, you may be recognizing, well, why don't I go for the US option because they're exempt from the 15% withholding tax, whereas the Canadian alternative is subject to the 15% withholding tax. Well, that's where we get back to don't let the tax tail wag the dog. And sure, the dividends or the distributions are taxed more favorably, but we do have to keep in mind that if we're going to go out and purchase a US listed ETF, well, that's going to require there's going to be a cost to essentially convert our Canadian dollars into US dollars and then go buy that fund. Along with that, there's the complications of the currency fluctuations. So if you are actually going out and buying a US denominated investment, changes in the dollar, the US and Canadian dollar, the exchange rate, that actually impacts your investment. Not to mention that it's just one extra step, one extra layer to track, and there's a lot of complications that come with that. So although yes, from a tax perspective, the US ETF looks to be more favorable than the Canadian listed one, again, we need to look at the full picture here, and in many cases the cost incurred to go out and buy this ETF may actually wash that out. It may actually be more costly and more stressful to go out and buy a US fund that it negates the purpose, it negates the point of trying to evade this 15% withholding tax. So again, just look at the full picture there. Don't let the tax tail wag the dog. And my rule of thumb, this is my personal opinion, is that when you have the opportunity to stick with a Canadian listed ETF, whether that's in your TFSA, whether that's in your RRSP, or whether that's in your non-registered account, that's the route that I would personally lean for. But that is strictly my opinion. You can take this chart and interpret it as you like. If you enjoyed the video, feel free to give this one a thumbs up and subscribe for more content. We post videos on the channel here every week. If you are by some chance a beginner investor and you've made it this far in the video, we do offer full-on courses on how to get started with investing in our Investing Academy. That's that first link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.